There is an old industry joke that the fastest way to become a millionaire is to start as a billionaire and buy an airline. It's a punchline rooted in a harsh reality. Pandemic disruptions, fuel price spikes, and geopolitical shifts create a level of volatility that traditionally destroys capital. Despite those risks, Apollo Global Management recently committed £5.7 billion to acquire easyJet, one of Europe's largest low-cost carriers. This raises a question. Why are some of the world's most sophisticated investors moving billions into an industry famous for wealth destruction? Apollo Global Management operates as a massive alternative asset giant, overseeing hundreds of billions of dollars across private equity, credit, and infrastructure. They were not the only ones pursuing the airline. Rival firm Castlelake was actively engaged in the bidding process until very recently, when they withdrew and cleared the way for Apollo. An intense bidding war between these private equity firms suggests a deliberate strategy based on long-term projections rather than short-term market sentiment. While retail investors often focus on high-growth technology, private equity is identifying a durable advantage in physical transportation networks that public markets are currently overlooking. Securing the support of easyJet founder Sir Stelios Haji-Ioannou removed the primary obstacle to the deal. His family remains the airline's largest shareholder, controlling a 15.3% stake. Under the terms of the transaction, the Haji-Ioannou family receives approximately £855 million. The deal is structured so they retain a long-term investment interest. This arrangement avoids a full exit, keeping their capital tied to the company's future performance. Prioritizing the founder's ongoing involvement suggests Apollo seeks operational continuity and generational wealth preservation, prioritizing these over the typical rapid exit associated with private equity. This acquisition follows a specific playbook used by ultra-high-net-worth investors to preserve capital by owning essential infrastructure. The first pillar is strong cash generation, providing immediate cash flow from high-volume ticket sales. The second relies on an established customer base, deeply integrated into the mobility landscape. The third involves high barriers to entry, making it nearly impossible to replicate established logistics. Viewed through these three pillars, easyJet represents a defensible fortress of cash, despite the broader industry's reputation for volatility. This deal reflects a global reallocation of capital. Wealthy investors are moving away from purely digital or financial assets and toward the physical infrastructure that underpins the real economy. Owning transportation assets provides direct exposure to tourism, business travel, and logistics, the basic drivers of economic activity that remain relevant even as technology shifts. By controlling these networks, billionaire-backed funds are positioning themselves as the toll collectors of human mobility. Ownership of the physical world's pathways provides a more reliable long-term generator of wealth than almost any other asset class. Historically, airlines were owned by thousands of public shareholders. Today, that ownership is consolidating into private asset managers who exert total control. Slower economic growth accelerates this trend, as private capital hunts for strategic assets that can withstand a downturn. The era of public shareholder dominance in these legacy industries is giving way to a systematic takeover by billionaire-backed private funds. The easyJet acquisition provides a blueprint for how ultra-wealthy capital seeks to preserve its power by acquiring the essential physical infrastructure of the modern world.